Hello class, welcome to lecture 35 of AREC 333. Today we will start with the last topic for this course, which is budget. So there will be several types of budget. There are 4 different types: enterprise budget, partial budget, whole farm budget, and cash flow budget. In this course, we will only cover the first 2. We will not cover the whole farm and the cash flow budget. So there was a chapter in DBIRD in 2012, chapter 19, which covers budget. But for this course, I'm actually not using that chapter. Rather, I'm using 2 or 3 examples that I'm hoping that you will have hands-on experience in learning this topic. And I also want to emphasize that the budget, I will probably spend 2 or 3 lectures, maybe 2 lectures on this topic. And then the last lecture, we will probably just do a review of the whole course. So for the budget lectures, you will not be, I will not test you on this topic in your final exam. So, but still, I would encourage you to go through those 2 lectures because a lot of the analysis that you need for linear programming and production function analysis, you actually need information from budget. I also want to mention that the course evaluation, I think, is available now, and you have until December 7th to finish the evaluation. I do want to thank those of you who provide comments to me in the midterm evaluation. Those comments are really helpful for me to improve this course. And this is actually the 2nd time I'm teaching this course. So again, for the course evaluation, I would again appreciate your comments, and those will help me improve the teaching for next year. So the students who are taking this course next year will actually benefit from your comments. So, so far in this course, in the production economics, there are actually 3 categories of empirical tools. We covered production function analysis and spent quite some time there. And I think some of you probably don't like the production function, some part of the production function analysis. There's a little bit of more math there. And after that, we also spent quite some time on linear programming. And then we have one last category left, which is budget. I could spend a lot of time on this topic, but since we only have 3 lectures left, and I will try to do my best to cover the most important points in budget. So first is, what are the budget types? And I remember I mentioned in the outline there are 4 different types of budget, and let me explain first what is the enterprise budget. So here, the enterprise, when when we did lectures on linear programming, and there actually we had the farm management example, if you still remember, and there we have corn, soybean, and raising cattle. So each of those 3 is one enterprise, or I think you can also say it's a output. So the cost to produce each of those is actually one enterprise budget. And in that example, we did provide 3 tables there, and those are very brief summarize of the enterprise budget. In this lecture, I will show you a more detailed example of a enterprise budget. So basically, in the enterprise budget, there's a lot of items for different costs of production. And then after you list all of those costs, you can also assume the price of the enterprise or the product from that enterprise. And then you can do some further analysis about the revenue, the cost, and the profit. And you might also be able to do some further analysis, for example, sensitivity analysis. So enterprise budget is a very simple and powerful tool for analysis and planning. And that's why we cover this topic in this course. So it is a statement of what generally is expected from a set of practices when producing a specified amount of product. And I will explain why I highlight specified amount here is because if you have different amount, then the cost of production could be different. And it also includes the revenue and the cost, or sometimes called expenses, incurred in a production for a particular product. And I will also explain what is a particular product when we actually work on an example. And the typical components in the enterprise budget are revenue, variable costs, sometimes called operating costs, and then also fixed costs. So those are useful in probability and break-even analysis. Some enterprise budgets did provide profitability and break-even analysis. Others only provide you those different items of costs. In addition to enterprise budget, there are also several additional types of budgets. So the first one is partial budget. So partial budget, we will probably spend a little bit time on this topic in next lecture. So this budget only considers revenue and expense items that will change with a defined change in the plan. So in a partial budget, the decision maker has to first figure out what's the defined change, or what's the change that a producer might be interested in. And once that change is defined, then the budget only focuses on the revenue and the expenses that's affected. All of the rest of the budget that's in the enterprise budget, those will be ignored in the partial budget, or will only show in aggregated terms. And then there's also the whole farm budget. As we mentioned in the farm management example, there were several enterprises there, corn, soybean, and cattle. So the whole farm budget will summarize the major physical and financial features of the entire farm business. So it's not for one particular enterprise. It's all of the enterprises in the farm, and also there are other, for example, here the financial features of the farm. And there's also a cash flow budget. And again, this is not the focus of this course, but I'd like to bring to you that the existence of such budgets. And when in this course, in the production economics, when we mention budget, it is actually, we're not referring to the cash flow budget. Rather, the focus of this course is enterprise budget and partial budget. So in the cash flow budget, this is where the farmer collects the receipts and the expenses for a production period. So this one might help with tax and other purposes. Let's actually use a example to help you better understand the different costs listed in the enterprise budget. So here we will use the irrigated potato enterprise budget. And in E-class, there's a Excel and a PDF version of the enterprise budget for irrigated potatoes. So if you haven't downloaded them, you should probably pause and have those ready. And a few things we should mention before I actually go to the details of the cost. First is that this enterprise budget is for a potato land base of 780 harvested acres here. So if you are using this enterprise budget, however, your farm is only, for example, 100 acres, 100 harvested acres, then you probably need to be more careful here, is because the cost for a large scale farm sometimes might be different for a small scale farm. So you need to keep those in mind. That's why in the previous slide, we say that this is a, this is here. It's for a specified amount of product. And we also mentioned this is for a particular product. So this is for the potato under irrigated conditions. If you are using this enterprise budget as a reference, however, your farm or the potato production that you're interested is not irrigation based and is not based on pivot system, then you also need to be careful when you are using this enterprise budget as a reference. So also, we mentioned that the yield here in this enterprise budget is for a certain range of yield, and there was also some marketable yield assumed in the enterprise budget. So you need to be careful when you're using the enterprise budget to figure out which specific yield actually applies to your situation. So let's actually have the enterprise budget ready and take a look at this budget. So this budget is, as you can see here, there are several tabs here. This is an introduction tab, and this is from Manitoba Agriculture. And you can see here, first, it mentioned this is an irrigated processing potato. It also mentioned this is based on 780 acres production. So again, need to be very careful about those. And you can go to the summary tab there. So here, this is actually the main enterprise budget here. It has several categories of cost here, but let's first take a look of this budget, the different columns here. So we can see here, there are different yield. So there are actually in this budget, whoever developed this enterprise budget is trying to better fit the need of different farmers whose yield might fall here, there, or 425 or 475. So you need to pay attention to which yield actually applies to your farm. And each column, as I mentioned, corresponding to one yield. And then this screen I'm showing you now, A here is the operating cost here. And if you scroll down, there's also fixed costs and then labor cost. Here, the total cost of production is the summation of operating costs, fixed costs, and labor cost. And once you have the information for those different costs, then there's also profitability and break-even analysis. Let's actually work on the cost first, and then later on we will come back to the profit and break-even analysis. So the first item, as we have seen in the Excel file, is the variable cost. In the Plato enterprise budget, is called operating cost. So sometimes it's called variable cost, sometimes it's called operating cost. It's the same thing. So there you have a lot of items there. So usually it's seed, feed, fertilizer, and those stuff. So those are typically categorized as variable costs. And here, if you pay close attention, there's two different types of labor. Now let's actually come back here. So here, there's hired labor. So hired labor is variable cost. And there's also another type of labor here. This own labor is not variable cost. So you need to differentiate between those two different types of costs. So here, the variable cost is A1.10. And I actually have a screenshot of the all of the operating costs here. And you can also see here that the interest on operating is also included here as the operating cost or variable cost. So again, I'd like to actually emphasize here the linkages between the enterprise budget and the production function analysis we covered in this course. Remember, we said if we have two variable inputs, then our production function can be written like this. So here, X1 and X2 are variable costs. And the costs actually listed here in this table, those are the X1 and X2. And X3 till Xn, those are fixed costs. So we have this conditional here to separate the variable cost and the fixed cost. So whatever comes in front of this conditional sign here is variable cost, and after that it's fixed cost. So if you have more variable inputs, you can maybe write this as X1, X2, X3, X4, and then from X5 you have fixed cost. So for most of the production function analysis in this course, we said we're not interested in those fixed costs. And then for notational convenience, we usually just write it this way. If you write the full function form, it actually should be that. So there's condition, the production function, there's fixed cost there. And most of this course, we spend time on analyzing what's the choice of the variable cost. So then there's also fixed cost in the enterprise budget. So again, we already mentioned what's fixed cost at the beginning of this course. So those costs, they do not vary with changes in production output. And I have some example here. So for example, if you purchase a tractor or farm machinery, then that is used for the full farm, for the whole farm, then that is considered to be fixed costs. There's also permanent labor, management, depreciation, and so on. And there are also some costs that's difficult to allocate to a specific enterprise, for example, to corn, to soybean, or to cattle. And that is also included in the fixed cost. So let's take a look at the potato example. And we can find here the fixed cost here include land, depreciation, and investment here. So the depreciation is the annual cost. So here this enterprise is for a year. So that's the annual cost of the declining value of things like tractors, machines, and buildings. So those are the depreciation. So in this budget, the depreciation is the annual cost. It's not, for example, if the farmer buy a tractor, spends, let's say, 100,000 on a tractor, then here, if the tractor is used for 10 years, then this should be 10,000, 100,000 divided by 10, and that's the annual cost if you don't use interest here to help you calculate the depreciation. And you don't include the whole 100,000 here as your fixed cost. So those here, you should include the annual cost. And the other cost that's difficult to include in the specific, to be allocated to a specific enterprise, there could be overhead cost, or there might be other costs such as record keeping or budgeting, stuff like that. So those are the cost, the fixed cost and the operating cost. And as we mentioned here in the Excel, there's actually also the labor costs, and here include the total cost of production is a summation of this number. This is total variable cost, total fixed cost, and the own labor. So this number you should verify is a summation of those three. You can actually try to click this, and there's a formula. There's a formula here, and formula here, and you can see it's a sum of D21, D27, and D30, and this is D21, D27, and D30. So this Excel, they don't allow you to make changes to the summary tab. And I think in the risk analysis tab, you can make some changes there. But however, if you click a specific cell, you will be able to see the formula they used to calculate the values in those cells. So those will help you understand how they did the calculation. So that's the cost component of the enterprise budget. As we mentioned, there's also the revenue and the profitability and the break-even analysis components. So it's here, this profitability and break-even analysis. So here in this component, there are several parts here. First is the revenue, and then there's also the marginal returns, and there's also break-even price and the break-even yields. That's actually take a look at those one by one. So first is revenue, and I think by this point you should pretty confident how to calculate revenue. Revenue is actually the quantity, so the physical output, which is a quantity, if you multiply that by the price of the product. And for agriculture products here in this enterprise budget, farm gate price was used. So here, this revenue, $3,505.20 is the price, and this is the output, the quantity. So if we go back here, this $3,505, and if you actually click it here, you will say it's F39 times D37, and F39 we can see here is this cell is the marketable yield per acre, and the F39 is actually, sorry, the D37 is actually here. So D37 is the price. So you can see here that in this enterprise budget, the developer actually assumed the same price for all different columns here, and remember each column is assuming a different yield. So no matter what the yield is, the price is the same. So the product will be the same. That's how you calculate the revenue. And we can also take a look at some marginal returns here. So there's different names in different budgets developed by different persons. So in this budget, it's called marginal returns here. And this is actually the profit that we have been analyzing in this course. So this revenue, or this marginal return or profit, is actually your total revenue minus your total cost. And depending on which cost you're deducting here. So you can either deducting the total variable cost, or you can deducting both the total variable cost and the fixed cost. So depending on which cost you're deducting, then you can use the profit for your decision making for different purposes. So we can take a look at here. There's two different profits here. So this one, this 635, if you go back here, it's this cell there. So this cell, as you can see, is your revenue, which is F40 minus D21, and D21 is the total operating cost, and you can also tell from here. So this is a marginal return over operating cost, or over variable cost. So total revenue minus variable cost. And here, this one is your total revenue minus your total cost. So the total cost includes, in this enterprise budget, the variable cost, the fixed cost, and the labor cost. So let's go back here. And if you check, this is your total cost, and this is the total revenue. And if you have the total, you can see here the total revenue is smaller than the total cost. So your marginal return or your profit here is negative. And if you take a look at this Excel here and pay attention to this number here, it has a parenthesis here. So that means it's a negative number, and this is a positive number. So you need to be you need to get used to the different formatting here, and need to be very careful when you see apprentices there. Usually there's negative profits there. So the marginal return, depending on whether it's over operating costs or it's over total costs, that can be used for short-term or long-term decision making. So the enterprise, so that particular enterprise here is the irrigated potato. It must generate positive returns above the variable cost or above the operating cost to operate in the short term, because if the profit is positive, that means the revenue can at least cover the operating cost. However, for the decision whether the enterprise should exist in the long run, then the attention should be the marginal return above total cost, because in the long run, the fixed costs should also be taken into account. And to have a positive long run profit, the revenue need to be above the total cost, not just the operating cost. So here it's both variable and fixed cost. And in this enterprise, there's also the labor cost here. So here, some note about the opportunity cost. So in this enterprise budget, it's actually a good example because it included the opportunity cost. So some of those opportunity costs here are the interest on land and on labor. So a lot of budget doesn't have this on land and on labor, and those are actually, although it seems like free, but it's actually an opportunity cost. It's because if, for example, the on land, if the farmer doesn't use it for irrigated potato, the farmer probably can rent it for additional revenue. And those additional revenue that can be gained or obtained actually should be counted as the opportunity cost here. So take a look at this enterprise budget here. So here we can see there's on labor here, and there's also on land there. So it's good to include those opportunity costs, and you should actually learn in your elementary economics course that opportunity cost is a very important concept in economics. And if you don't include those opportunity costs, then the decision, your decision, you might arrive at the wrong decision there. So in this enterprise budget, we should actually take a look at the marginal returns here again. So for the short run, it's all positive. So all of those 4 different marginal returns under different yield, they're all positive. So the enterprise should run under short run. However, in the long run, only those 2 yields can generate positive profits in the long run. Those 2 are actually negative. So if you are using this enterprise budget as a reference, and if you're expecting your yield based on your production conditions, if you're expecting your yield is between 325 and 375, then it's probably a sign here that in the long run, you should not operate this enterprise. It's because you will get negative profit. However, if you're expecting that your yield is high here, either 425 or 475, then in the long run, you're getting positive profit. So that's what you can rate from this enterprise budget. And if you pay attention to the budget here, you will notice in this, at least this summary tab, there's also the break-even price and break-even yield there. So let's actually also take a look at those break-even prices and yield. So those are what's generally called the break-even analysis. And it's a technique for studying the relationship between cost and revenue at different levels of production and different prices. So it estimates the point at which the farm's revenue is just equal to its cost. So here it could be either variable cost or total cost. So when they are exactly the same, the revenue and the cost is the same, then we say it's break even. So it gives, this break even analysis gives an indication of the maximum acceptable level of cost and the point at which if the costs increase, then the farm will not be profitable. So once the cost is above that point, the profit will be negative. Or it could be the minimum acceptable level of benefit given an estimated level of cost. So that's why we're having both break-even yield and break-even price. So it can answer different questions based on whether you're looking at break-even yield or you're looking at break-even price. So for the break-even yield, this is assumed that for a given price and cost, so pay attention here that the price is given at what level of production. So when we say level of production, that means yield. So given price, what's the yield that will make the farm break even? So the question is asking what yield. So that's why we say this is a break even yield. And a break even price is that your yield is given, or yield and your cost is given. And then what's the price that will make the farm break even, or here we should say enterprise break even, or if you translate that, that means the cost equals to the revenue, or the profit equal to 0. So calculating break-even budgets in price and yields, it can help the farmer plan the enterprises, and particularly when the farm is considering making a change. So there could be different changes, and there are several examples here. So if the farmer is considering making a change in production or commodities, then there will be yield change. So the price will be the same. However, the yield might be different. And if the farmer is considering change input use, then there will be changes in the cost. Or if the farmer is considering changing market, then price might be different. For example, if you're selling beef in domestic market, or if you're exporting, then you will face different prices. So in this particular potato example, we can think about if the farmer is interested in changing the variety of potato from one variety to another. And there could be analysis, break-even analysis in both yield and the price. So if the production potential of this new variety that the farmer is considering, if it is unknown, so here the yield is unknown, Then the break-even analysis can estimate the minimum yield that will have to be achieved to make a change worthwhile. And on the other hand, if the yield is known, so I know what the yield of the new variety is, because there's another farmer that I know, he already planted this new variety for several years. So he shared with me information about the yield. Then I know the yield, but I don't know about the price. So if that's the case, then the break-even analysis should be focusing on the minimum price that must be obtained to make the change economically feasible or worthwhile. And there could also be cost variations. And if the farmer is changing to this new variety, then what's the changes in the cost? So let's take a look at the enterprise budget here. And first here, this is the assumed farm gate price. And as again, we mentioned, this is the same for the different yields. And this is the total cost of production. Let's first take a look at the break-even yield. And here I'm focusing on the break-even for total cost. So if you're interested in break-even yield for operating costs, then here you should not use this number. This 4,203 should be replaced by the total operating cost. So again, let's focus on the break-even for total cost. And in the Excel, in the enterprise budget, it mentioned that the break-even yield is 389. And how is that calculated? So the actual calculation is very easy, actually. So yield is cost divided by the price per unit. So here again, the break-even we're interested is for total cost. So we find out what the total cost is. And then we divide it by the price, the farm gate price that we assumed. So when we're calculating break-even yield, we are assuming that the price is actually fixed, or we know what the price is. And there's actually a little bit more information here. And there's 9% shrink and 6% dockage here. So where can you find those information? Is actually here in the input here. So let's say, I think it's somewhere here. Okay, so here you can see in this enterprise budget, there were both information about the dockage or the shrink. And if you go back here and you check that cell, and you can take a look at the formula there, and you can find here is the cost divided by price, and then also divided by 1 minus the shrink and the dockage here. So there's a lot of very detailed consideration in this enterprise budget, and not all enterprise budgets are like this. So that's how you get the break-even yield. And let's also take a look at the break-even price. So here, the break-even price, it depends on which yield you're looking at. So there's different break-even price for different yields. And so this 1523 is associated with that yield, and 1318 is associated with that yield. So different break-even price for different yields. Let's take a look at how is this 1523 2, 3 calculated. So in order to calculate this, we again need several information. So we need the total cost, and then we also need a yield. So here, why do we need a yield? So this break-even price is actually, it's similar to the calculation of break-even yield. So break-even yield is cost divided by price, and break-even price is cost divided by yield. However, you need to pay attention here that the yield is not the yield there. It's actually the marketable yield. So you need to use those information here. It's not the gross yield, it's a marketable yield. And that because only the marketable yield will generate revenue for you. So we have the total cost, and we have the marketable yield, and then that's how we calculated the break-even price. So here again, this break-even price is break-even total cost. If you're interested in short-term decision and you only need to break even operating costs, then the break-even price is much lower, is $10.40. So that's the calculation of the break-even price. And we can actually also take a look at the calculated break-even prices here. So here we can see that those are the assumed market price, and those are the calculated break-even prices in the short run. So if it's above the operating cost, then it's short run break-even price. And we can see here that the farm gate price are higher than all of the break-even prices for those 4 different yield assumptions. So that means that the farmer can make positive profit in the short run. However, if we take a look at the long run break-even prices, and if you compare that with the farm gate price, and you will notice that for those two, the break-even price is higher than the farm gate price. So you actually need a higher price to break even. So that means if your yield are it's either 325 or 375, then you will not be able to break even. And for those 2 yields, the break-even prices required is lower than the farm gate prices. So under those 2 yields, the farmer is able to break even. So this is in the long run. And in the short run, as we mentioned, this the prices, the break-even prices are all lower than the farm gate prices, so the farmer is able to break even in the short run. However, in the long run, only these 2 yields can break even. So that's all I want to share today. And next lecture, we will move on to partial budget.